So hello, everyone, and welcome. Thank you so much for joining us today. This masterclass is hosted by FamilyOfficeList.org, and I'm Danielle Patterson, the CEO at Family Office List, and I'm thrilled to welcome you to today's episode. Our guest today is David Teten, a partner at Coolwater Capital, and David will share his insights into the forces disrupting investment management and how the innovative startups poised to transform the industry. He'll explore how organizations can succeed in focusing on technical expertise, user experience, and building trust, all key factors shaping the future of the field. Before we get started, I'd love to share more about David. I'm honored he's here with us today. As I mentioned, he's a partner at Coolwater Capital, which invests as a limited partner into general partnerships and fund management companies. Coolwater also runs an accelerator for emerging fund managers, which has graduated 256 VCs who have collectively raised $3 billion and invested more than 8,000 companies. He is the chair of PEVC Tech, a community of private equity and VC funds working to generate alpha through AI, technology, and analytics. He's the chair of Founders Next Move, a community for founders exploring new ventures. And previously, David has founded Versatile VC, backing investment tech companies that help investors generate alpha and succeed. He served as managing partner of HOF Capital and was a partner at FF Venture Capital and the founder of Harvard Business School Alumni Angels of New York. So as you can see, I could go on and on. He holds an MBA from Harvard Business School, a BA from Yale University, both with honors, I should mention. And so as you can see, he really has a wealth of experience and deep insights into the space that truly set him apart. So we are very fortunate to have him here today. And before I hand the reins over, I will just go over a few housekeeping notes. I have enabled the chat, as many of you have discovered. If you haven't yet, please feel free. Go ahead and introduce yourselves. It's a fun opportunity to network. The Q&A is where I would like to ask you to drop your questions because often the chat can get busy. David, throughout his presentation, really wants to engage you. This is why we do them live. So drop your questions there. He and I will both be managing throughout. It is an action-packed presentation for us today. So without any further ado, I will pass it over to you, David. Thank you so much for being here and sharing your wisdom.
Thank you so much. I appreciate the chance to participate. If we do not get to your questions, feel free to email me afterward and I will try to address them. This is an extremely jammed presentation. My kids have taught me you've got to do things in extremely short increments, preferably with dancing and music. So there will not be much dancing today, but we'll move at a fast pace because what I'm presenting today is about a 15,000 word research paper, research series that I published in TechCrunch and Institutional Investor, and I'm distilling it to 45 minutes. There is no need to take notes because you can download this whole slide deck, view it at this link, teten.com/DI, and I'll be sharing that link at the end of our presentation as well. So I'm going to be talking about the investment industry and who's disrupting it. And people use the disrupt in a colloquial way, but I'm trying to use it in the technical way, using the definition of Professor Clay Christensen at HBS, famous for, among other things, writing the book, The Innovator's Dilemma. So Professor Christensen articulated a pattern of disruptive companies, which, to simplify it, is that disruptive companies often come in providing a service that is simple, well below what people are used to in the industry, and they work up from that. So in investment management, I think a classic example of that is Vanguard. When Vanguard launched, people said, this is a really stupid idea. You're offering mediocrity at a low price, sure, but mediocrity, who wants mediocrity? And no one's going to buy it. And it took them quite a while to get any significant AUM. Vanguard as a firm and indexing as a whole have obviously become major forces in our industry. And I show here on the slide a couple of other examples of firms that I consider disruptive in the technical sense in our industry, some of which I'm privileged to be an investor or team member of. So a few words about Coolwater, which Danielle talked about. We run an accelerator, and we also invest in emerging fund managers, mostly VC funds. So we are at the hub of innovation. But my particular interest is investment tech, which I define as technology that helps investors to generate alpha, helps people like me, you, to do our jobs more effectively. And so a lot of the companies I'm talking about are companies I'm an investor in or involved with, which are examples of this. And I'm particularly excited, no surprise, about companies that I view as disruptive to the traditional investment management industry. Danielle already read my bio. My mom, I think, is attending, so she thanks you for reading that bio. You didn't mention the award I won when I was 7 years old, but that's okay. So I'll just say a few words about the family office world, given your background. So I have an interest in several levels. My parents and grandparents are all entrepreneurs. My grandfather co-founded Ziff Davis, who's Bernard Davis. So I come from some family business background. I have an interest in the family office world. On one level, they're LPs and some of the funds that I work with. They're also bigger and bigger consumers of technology. And I think family offices are following the same pattern I saw hedge funds follow and private equity funds follow over the past few decades. Hedge funds and PE funds used to be a very fringe, marginal part of Wall Street. And then they gradually institutionalized. They developed their own recruiting pipeline, cultural norms, tech vendor norms, and they became major parts of finance as a whole. And I think that there's going to be big opportunity in vendors that specialize in serving the needs of the family office community. And so that is one of the reasons why I'm happy today to be working to be partnering with Family Office List to do today's webinar. So I'll say a few words about investment management and the weirdness of our industry, weird compared with most other sectors. First off, if you go to a burger restaurant, you ask for a burger, you will get a burger with extremely high odds. But you go to an asset manager and you ask for, hi, sir, may I please have some alpha? In many cases, you're not actually getting alpha, right? So the industry collectively does a pretty poor job of delivering the alpha that it alleges to be able to deliver. Burger restaurants that don't deliver burgers go out of business pretty quickly, but that is actually not true in investment management. It is also largely a zero-sum game. In most cases, if you get alpha, someone else doesn't. You're all fighting over this zero-sum pie. There are, of course, exceptions, which is not so true in restaurants. I can get a burger, you can get a burger. We're all happy. One of the ways you get out of this dilemma is there's actually multiple pies, which I will get to, that we're all collectively getting benefit from. So I might ask for one thing from my investment manager. You might ask for something else. We both can get different burgers and both hopefully come away happy. There's also a clear tension between size and returns. The burgers at McDonald's are pretty standard, right? You might argue your local boutique chain is better than McDonald's, but nonetheless, McDonald's offers a very standardized product and people seem pretty happy with it. But in our industry, the successful players get bigger, 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 and that, many would argue, does not correlate with positive returns. But there are the services the big players offer, which we will get to, which are part of why they continue to grow. There's also principal agent conflicts in every industry, but in our industry, we have even more because there are so many intermediaries, right? And I'm an intermediary too, I admit that. And so it creates lots of room for fees. To use the wonderful metaphor from Bonfire of the Vanities, right? We're passing around the golden cake and we're each getting paid from little crumbs of the cake that fall off. But what does the client get? Maybe a little less cake. So it's also a very lucrative industry, which attracts lots of entrants, and that creates lots of room for perhaps, and some would say, an oversupply of talent in the industry relative to other industries. Lastly, we have a lot of power as an industry to create global economic risk, right? If McDonald's goes bankrupt, we're all going to eat somewhere else, right? Our industry can create the 2008 GFC. We can create all sorts of other socializing, destabilizing phenomena. And I think that the jobs to be done framework that I'm discussing helps explain why that occurs. So the good news is I do see, because there's so many new entrants, so many people want to be in the industry, it creates more leverage for the money holders. When I say money holders, I'm talking about the family offices, but also the endowments, the sovereigns, the people who are giving money, even though they themselves might be fiduciaries, to the asset managers. So if you had asked me as a novice investment manager 15 years ago, what is the job to be done? Why are people giving you money to manage? I would have said alpha, right? Duh. But that's actually the wrong answer. There are about 24 different jobs to be done, which people are asking an asset manager to do when they give you money. And my co-authors and I surveyed money holders of all stripes, sovereigns, family offices, and so on, asking them, why do you give money to an asset manager, right? What is the job to be done? And that gave us a lot of insight into why they choose different vendors, why they fire different vendors, and also where is the room for new entrants? Because going back to Christensen's formative insight, the disruptive companies of tomorrow are the ones that today are serving one or two jobs well and often doing a terrible job in everything else, right? That creates room for true technical disruption. So I'm going to go through these different jobs and give examples of some disruptive companies that are addressing these jobs in typically a very targeted way. Some of these companies you might say, oh, that's not a competitor, right? That's just a niche player. That's just a startup. Well, that's what people said about Vanguard in the 70s. That's what people said about AngelList 10 years ago. Those are the competitors to today's mutual fund managers, hedge fund managers, multifamily offices, the other incumbent players today. So the first set of jobs beyond are technical, right? What is the experience? What is the offer that we are giving you? So, and this breaks down into first your strategy. So let me go through this. Again, I'm going through at high speed. So the first job is alpha, right? So if you say my number one job is alpha, I don't care about anything else. I just want to grow my pot. Well, you know, it's really, really good at alpha are people in emerging asset classes. If you had invested early in crypto, in internet domain names, right, you would have made extraordinary returns with lots of risk, illiquidity risk, legal risk, reputational risk, and so on. I would recommend looking for those new asset classes that other people view as reputationally questionable, legally questionable, ethically questionable, because you can do really well there. Another job to be done is don't lose money, right? That's very common from family offices. They say they care more about making sure they don't lose the family family nut, as opposed to trying to grow it. So how do you do that? Well, structured products are a great way to do it. Axio, for example, acquired by Capital, is in this business. So they're offering you a guarantee from a reputable counterparty saying, we are not going to lose any money, or we're not going to lose more than 10% of your money, right? So that gives you very explicit downside protection. Another job to be done is to match your liabilities. The number one liability for all of us is inflation. Who's good at that? Well, the Treasury Direct, right? iShares, really good at that. It's an explicit contractual promise from the US government that you're going to match the rate of inflation. iShares, right? That's another way to solve this issue. Another is to minimize your expenses, right? A friend of mine says he likes wealth managers. They'll manage your money until there's none left. So if you minimize your expenses, that is a very predictable way to say that you're going to have more money at the end of the day. Vanguard is by far one of the best examples of a firm that does a really, really good job of minimizing expenses, in part because their unusual ownership structure. Another is tax minimization. I remember meeting with a well-known New York City billionaire about our fund. The number one question was tax minimization. What are you doing to take advantage of QSBS? And it was very clear that was his top framework, is trying to avoid taxes. And so I think that early stage VC in particular is advantaged under a current tax regime because of QSBS, qualifying small business stock rules. Which, if structured appropriately, means that investments in early stage private companies can incur very, very little tax or zero tax, subject to all sorts of technical constraints, which I'm not going to get into. There's a company, Cap Gains, which specifically focuses on this issue, helping you to take advantage of QSBS regulation. Another job is exposure to targeted sectors. A family office will say, I'm really bullish on what are they bullish on now, right? So let's say they're really bullish on Brazil. They want to invest in things linked to Brazil. Fine. There's a whole set of ways that you can get explicit, specific exposure to that geo or that industry because you think you know better than the market that Brazil is going to be the next big thing. I'm an investor in Republic, which is a leading crowdfunding platform, and they allow very granular investments for even retail investors into specific private tech companies, specific crypto opportunities, specific real estate offerings, video games, right? So you can be as granular as that tiny little startup company. And maybe you're not even an accredited investor, but you can invest $300 into that small private company if they're on Republic. So they offer that, and very few other people will offer you that granular targeted exposure. Another is legacy. Surveys of millennial investors show this is a frequent issue, right? They want to be socially responsible in their investments. So I'm an investor in a stock. which is a company that provides asset financing in Africa and Latin America. They're one of the very few African fintechs that acquired a Latin American peer. And they're making money for investors, but one of the reasons why they get money is in part because they're accomplishing an impact goal of enabling economic growth in Africa with appropriate economic returns for investors. Another job to be done that I think we're all more sensitive to post-COVID is protection from tail risks, right? Doesn't matter how much money you have. If you have a home in LA that's not insured, you have a problem, right? If you got COVID, you have a family member with COVID, that was a problem. So Predate is a company which helps track these emerging tail risks, some of which will happen. I can say with 100% confidence, there will be some nasty tail risks over the next 2 decades. And it will behoove you to get as early insight as possible into what those tail risks are and appropriately protect yourself. So the next set of technical jobs to be done are the execution of the investments, right? How do you actually deploy the capital? So sourcing, origination. In my world, I call it origination. In hedge fund land, public markets land, they call it trade selection. So I'm an investor in StockTwits, which is a tool for retail investors to discuss the markets. But they also sell data to institutions and others to track retail sentiment collectively. So if you see that the retail investors are super bullish on a certain meme stock, doesn't matter the fundamentals, right? Maybe you can take advantage of that trade, or maybe you should short them. I'm not making specific stock recommendations here, but they have very granular data about retail sentiment. Another is research. An investor in Drop Technologies, a really interesting company out of Canada. They are a multi-brand loyalty platform. So in America, if you have frequent flyer points, those points are typically fungible to only a small number of things, and you can get them mostly from your airline. In Canada, there's a whole ecosystem where you buy your food at Tim Hortons and you buy your books at a certain book chain, and those points are fungible between all those different chains. So Drop took that Canadian model, brought it to America. It's free. I recommend you sign up. When you opt in with your credit cards and debit cards, you're getting points from all your economic activity. You're getting customized rewards. So it might say, oh, I see you used to go to Starbucks a lot, but you haven't been there the past 2 weeks. Here's a coupon for $5 at Starbucks, right? And they do a deal with Starbucks to do that. On the back end, they have super granular data about your debit and credit card activity, fully opted in. You explicitly gave permission to Drop, and they are selling that to investors and others. And that allows for very granular decision-making about a company you're considering investment in. The next is the actual decision-making process, right? Do we cut the check? So when I worked at Bear Stearns, the way this worked is we, the analysts, we'd write a memo, we'd make some pivot tables, and we present it to the committee, and they would sort of bob their heads and review the memo, and they would discuss it in sort of this Talmudic format, and then they say, okay, boom, we're putting money into this deal, or we're underwriting this company, or whatever. So that works, but there are a number of problems with that model. One of them is that you're not typically, Excel doesn't allow functionality to model all of the different ranges, right? So if you're really doing a forecast for a company, think about all the variables and the ranges of those variables, right? There's a range of inflation, there's a range of sales growth, there's a range of how competitors will adjust their pricing strategy. Every one of these will impact your outcomes. So Bullet Point Network is a New York company that I advise, which has a better way to approach this, where you could track all those different input functions, track the ranges, make explicit assumptions about each of those ranges, and document them. Because one of the problems with spreadsheets, which are where a lot of critical corporate data lies, is they're usually illegible a month after the transaction happens, right? The analyst put it together, leaves, it's not clear where the assumptions came from. So Bullet Point Network offers a standard way that you can track all that and post facto check, did I make a correct assumption? A friend of mine at Goldman Sachs says if she loses money, her boss asks her questions. If she makes a lot of money above what she predicted, she also gets a lot of questions, right? Because it implies she didn't appropriately fully understand the trade outcome eventualities. So Bullet Point was started by a former Goldman partner who's trying to make it easier to track this. Another job to be done is to manage your portfolio. Stratify is a company which brings institutional caliber risk management to retail, right? If you signed up for Fidelity, you may have gotten the standard questionnaire that says, are you high risk, medium risk, low risk, which is an incredibly crude way of judging your risk. If you're a real family office, right, then you're thinking through all of the different ways of thinking about risk, right? Duration risk, and maybe your family business is in real estate, so maybe you should stay out of real estate for your other holdings, right? You need to balance all that. So Stratify brings some of this institutional caliber thinking to retail. Another is exit. So at some point in the illiquid market, you have to hit sell, right? Find a buyer or counterparty. Firms like Axial, another New York firm, they help to systematically find that right family office or PE fund that will buy your holdings. Founders Next Move is a community I manage for tech founders who have exited and helping them figure out what comes next. It comes out of my own background as a serial founder, where I, at different points in my career, had this issue of I'm off the regular labor market path where you work up the ladder at some companies. What do you do next, right? Do you become an angel? Do you sit on some boards? Do you start another company? Do you start a studio, retire, get a PhD? And so I publish there for free all of my notes on different things you can do. And we have a community you can join for founders to meet one another, to goal of being to support founders and figuring out what happens next.
David, is that local to New York, or is it a virtual? Where are most founders? Yeah, incredible.
So it's global, anyone can join. And we have events. I mean, historically, it's definitely New York centric, but I welcome doing things elsewhere. We had some stuff in Miami, another sort of hub for this ecosystem.
Amazing.
So lastly is administration of the investments. So second mouse issue. There, let's switch back to full screen read mode. Okay, so tracking. So Adipar is another one of my past investments. Adipar is started by Joe Lonsdale, well-known tech investor, who started his own family office in his late 20s, an excellent age to start one. And he realized family offices usually run in Excel and PDF. And he said, there's got to be a better way to pull in the data from all of your different assets and track it all. Maybe an investor in 10 hedge funds, and you say, great, I'm diversified. But if they're investors in the same underlying investments, then you're actually not so diversified, right? Wouldn't you like to have some visibility into that? Maybe you own a boat, great. You have certain risks to that boat, physical risks, geopolitical risks, depending where it is, right? So you need to manage that. And so Adipar helps you to do all that. Another job to be done is optionality. People usually think of this as liquidity, right? It's why most high net worths, they keep a good chunk of their holdings in cash. But I would argue that's actually, except for the most risk-averse person, that actually is not the right thing to do. Some of the very sophisticated high net worths I know, like hedge fund managers, they keep zero in cash. They keep their holdings in liquid stocks because they say, if I need cash to go buy a boat, right? Either I have to sell stock or I could just borrow against my holdings. But why should I hold in cash, which is the lowest yielding asset? Max My Interest, another New York company, provides allows you to divvy up your cash among multiple banks, providing the highest interest rate available. So if you're concerned about the 250K limit, right, the FDIC insurance limit, no problem. You could break up your cash into 30 banks, 250K in each, that are paying in descending order the highest interest rate available. They're not the money holder. The bank is a money holder, so you don't have to trust Max to do it. They're just the switching hub, the Uber. So I really like that approach, although if you can avoid holding cash, you probably should. So another job to be done is compliance, right? So firms like Behavox and AQmetrics help you to stay in compliance with all of the relevant laws, depending on where you are and what you do. But there's also compliance for your religion. So Islamic Assets is the best known example of that, which has grown dramatically over the past decade. But every religion has this. So if you're Catholic, check out Ave Maria funds, investing in pro-life companies and organizations. Franklin Templeton offers Sharia-compliant opportunities. JLens for Jewish investors is an initiative of the ADL. So whatever your religious alignment, someone out there will be happy to take your money. So another job to be done is succession, right? What's the point of making money and gaining money if your heirs are perhaps not such good fiduciaries? There's a whole universe of people who are happy to advise you on tax issues, right? And I'd say that's largely a solved issue, right? How to pass it on to your heirs in a tax minimized way. But I, as a father of four, I'm much more concerned about the kids actually competently managing the assets. right? And making good life decisions. I wrote a book around how to accelerate your early stage career, in part because I figured my kids would pay more attention to it if I got it bound and got Wiley to publish it than if I just lectured them, which I still do, much to their chagrin. And so I try to put in my own insights on how to take advantage of your youth. George Bernard Shaw said, youth is wasted on the young. I agree with that, but hopefully my kids can be wiser about their youth than perhaps I was. So the next set of jobs to be done are the functional jobs to be done. How is the product or experience provided to the client? So ease of use is a huge, huge issue, right? Especially the younger customers. They do not want to call customer service. They don't even want to talk with humans, right? That's why they go to the ATM instead of the bank teller if they can, for many, many transactions, including in some cases larger dollar transactions than you might think.
Wow.
So having a easy to use UI, user interface, is a huge deal in retaining these clients. It's one of the drivers of success of Robinhood and Betterment and other such new age providers. Mesh is a company which makes it much easier to manage your crypto deposits, which historically has not been a user-friendly experience, and that's one of the reasons they've been growing. Another, if you can't solve your issue by just pressing a button, then what's the next step? Customer service, right? Most people don't like it. So ASAP is another company investor in, which automates the customer service experience. Their data show that people actually prefer to engage with their AI-driven customer service interface as opposed to human. Why? Because AI makes fewer mistakes, it's more patient. And of course, there's a mechanism to kick it upstairs to a human where you need to do it. But no surprise, most customer service queries are pretty homogeneous. And if the technology works, right, and it doesn't make human level errors, then you have a better, happier, better experience and a happier customer.
Incredible.
Another reason people invest is access to networks. This is often amusingly crude. There's a well-known billionaire scion who was asked about why he invested in movie studios. Like, it was basically to meet starlets. And he said, there are cheaper ways to meet starlets than buying movie studios. I definitely have talked with people who said they want to invest in a certain company because they want to be on the cap table with a certain celebrity, a certain fund, a certain prominent founder. Xperity is a company I'm past investor in, subsequently acquired by Ipsos, a public French company, which is a highly automated expert network. So they're taking out all of the wrapping around tapping your network, and they give you direct access to the right person. So you contact them, you say, I want to speak with someone who knows the French telecom industry. They get you someone who spent 20 years in that industry and retired last week, and you can interview that person. I remember talking with someone who worked as a Cisco engineer, went to Harvard Business School, then worked as a hedge fund manager. And his sales pitch in getting the job was, hey, I worked at Cisco. I know a lot about telecom. I can reach out to the industry contacts. And he told me he actually thought that 3 years at Cisco was a total waste because he could have just gone to Harvard, gotten the job, signed up as a client of an expert network, and he can get these engineers on the phone, right, and skip the 3 years.
Wow.
I'm a former CEO of an expert network, so I have affinity for the industry. Another job to be done here is education, right? There's no continuing education requirement in wealth management. There is for doctors, but you know what? Your financial health can matter a lot. Perhaps there should be more of a continuing ed requirement, legally speaking, for wealth managers. Ask Wonder is another portfolio company which addresses the approximately 1 hour per day that white-collar workers spend looking up stuff on the internet. So it's different than Google, which gives you existing answers, and different than ChatGPT, which has imperfect reliability, although it's obviously getting better. Ask Wonder as a network of hundreds, thousands of researchers who will address whatever your question is and give you fast turnaround. One of their clients is McKinsey. I said, wait, hold, stop. McKinsey hasn't solved this in-house, and they said, nope, we're doing it for them because it's worth McKinsey's time, right, to make their staff more efficient. Another job to be done is self-discipline, right? This applies in health and a lot of other spheres. People can avoid a lot of issues if they just eat right, exercise, and don't spend money on stupid stuff. But as a parent, I certainly struggle with this. How do you get people to do the right thing, right? So Clarity Money is a past portfolio company since acquired by Goldman Sachs Marcus. What they did is you opted in your credit cards, it tracked all your spending, and it would give you pop-ups saying, oh, I see that you earn 50K per year and you're spending $10 a day in Starbucks. Right? Maybe not a great idea. Here's the problem. How do you get people to listen to you? Because it's kind of annoying to hear a pop-up every day. You should not be spending $10 a day at Starbucks because you earn 50K a year, right? So one of the things that they had to do was think about how do you gently nag people so they listen. I should take lessons as a father, right? And so you have to mix it in with positive affirmation, like great job keeping on your goal of being below $20 a week on Starbucks, right? Or I noticed that you canceled your Netflix. Good job. Now you're down to 3 streaming subscriptions instead of 4, right? You just reduced your burn. Good for you, to offset the nagging.
It's awesome.
Then there's the emotional jobs to be done. This is incredibly important. I find a lot of analytical people devalue this, but this absolutely matters. So peace of mind is a huge one. When people invest, they want comfort that they're not going to look stupid. They're not going to have to wake up sweating. A lot of people stay away from volatile investments because they just can't handle that. So I'm chairman of PVC Tech, which is a community for investors in private companies who want to know how to do their jobs better using AI tech and analytics. Our view is the public markets have clearly dramatically changed through use of these modern tools. Firms like D. Shaw, Two Sigma, Renaissance, they look more like software companies than like the traditional Warren Buffett model of going through a 10K with a pencil, which works fine for Buffett, but is not necessarily the way the whole industry is evolving. In the private markets, right, there's still many, many investors whose tech stack is Excel and Salesforce.com. So we're researching and sharing best practices in the space. And one of the things we do to try and address our members' peace of mind is we publish tech stack breakdowns, right? So the world is full of vendors who want your business, and they're all biased, right? Inherently. Who do you trust more? Well, if you're a family office, you'd like to look at other family offices and what tools do they use to track their investments, to make their decisions, to originate deals. So on the website for free, I share publicly the tech stacks of different fund managers, family offices, multifamily offices, with a goal of trying to make it easier to choose the vendors for your particular organization.
So valuable.
Another job to be done is social validation. People love, love, love to know that other perceived smart people are investing in a given deal, right? And so here you may recognize these two very prominent individuals. We have Elizabeth Holmes on the right, Bernie Madoff on the right. Holmes on the left. And both of them, part of the secret of how they got a lot of money from a lot of people who were reputationally smart was because they said, oh, there are these other smart people investing, right? And people said, oh, hot deal, right? I'm going to free ride in the due diligence. I don't need to do my own due diligence because such and such prominent investors in the deal. That did not work out well. So this speaks to the importance of understanding who exactly is investing and why do they invest. Because I feel like part of the secret of Madoff is this daisy chain of he got some real investors back in the early days when he wasn't fraudulent. And then he sort of grew and grew and grew from that. And everyone was relying on the prior person in this enormous pyramid. Yes, in fact, it was a pyramid. So another job to be done is exclusivity. People love to invest in things that are hard to get. This is particularly granular for firms like Earnest Analytics, another portfolio company. Earnest takes alternative data sets and understands them, analyzes them, mines them for their clients. And one of the interesting challenges they have is alternative data loses its value when it's too widely dispersed. So they've developed different pricing mechanisms for the clients who want the analysis and the data first and raw, as opposed to the people who are getting it later and more broad scale. This can be worth a lot of money to certain investors, particularly hedge funds, if they have first dibs on critical data. Another is control, right? One of the dynamics I've seen in the family office space is people, instead of investing in funds, they want to invest in directs, right? They'll tell me, gee, I don't want to invest in your fund, but just tell me your best deals. And I will tell them a priori, I don't know what are the best deals, right? No one does. So it's like asking the parent of a newborn baby, which one is going to be a contributor to society and which one's going to jail? I don't know, right? They're all kind of red and wrinkled and screamy. So this is the human need for control. Republic, which you talked about earlier, makes it easy to zoom in on the particular company that you're most excited about to cherry pick. Of course, then you're paying fees on a per deal basis instead of getting netting of fees as in a fund. It's a big trade-off. Another is excitement, right? People like to invest on something they can talk about at cocktail parties, right? It may be that the manager of the Harvard Endowment could have done really, really well putting the entire endowment in Vanguard. He is not going to get paid the big bucks for doing that, right? You have to be able to say, I'm investing in a range of things, I'm adding value on top of the indices, and I'm doing things that are noteworthy. So Indiegogo, another portfolio company, is a company which enables crowdfunding of new products or new movies or other new things. And you're explicitly typically not getting a financial return. If you go on and you see a movie, you might get a free t-shirt or lunch with the director if you put up some money, and people give them a lot of money, right? Many millions of dollars go on this platform because people want that excitement of being associated with a movie, maybe about a cause that's close to their heart or an exciting product. I am a past investor in a company called Interaxon, which makes a brain sensing headset. And when they first came to us and pitched us to invest, we said, this is super cutting edge technology. You haven't actually built it. It's not clear if you can build it. Why don't you launch an Indiegogo campaign and let's see, do people actually provide their credit card? So they ran a campaign and they got 300K in pre-orders for a product that did not exist.
Wow.
And to us as VCs, we said, well, that's validation, right? People are willing to commit 300K in advance, give their credit card number with an explicit warning that we may never ship this product because it may not exist, and that we invested in part based on that signal from the market. Another reason people invest is affinity. They invest because they want to be part of a tribe. So let's take ticker DJT, the Trump Media and Technology Group Corp. So this company, by any traditional metric, is just a wee bit overvalued, right? They currently have a $8.8 billion market cap and trailing revenues of 3 mil. So I don't think people are doing a DCF on this company. They're investing because of some combination of affinity, right? They feel an affinity for the incoming president and for, more broadly, the tribe of which he represents. And some of them think that he'll figure out ways to use his presidential power to support DJT. So if you want to invest for affinity, great, right? It's your money. Go ahead. If you're investing because you think you're going to make money and your goal is IRR, you might want to be a little nervous about a company with a $9 billion market cap and 3 million trailing revenues. Makes me a little nervous. I'm not making stock recommendations, but just saying. So my interest in investment tech is one of the reasons why I've been building Versatile VC, which is a fund that focuses on companies in the space, leveraging some of these communities and resources that we talked about. So an obvious question is, well, David, you just talked about the jobs to be done. What are the jobs to be done of this new fund, right? I have the advantage of a blank slate. How can I serve my LPs, right? I can't promise returns. That's illegal and an impossible promise to deliver on. So what else can you do for LPs? Well, for many fund managers, right, there are other jobs that you can promise to LPs and you can actually promise, right? You can say, I will do this. And that can help motivate LPs to engage. You can say, we have a well thought through process, right? We can't guarantee performance alpha, but we can guarantee operational alpha, meaning we will have a well thought out process. We're going to run the ship well, and that increases odds that we're going to generate good returns and not make stupid mistakes, right? So ask night trading, right? Difficult mistakes can cost you a lot of money if you know about that firm and its challenges. You also, as a private equity VC investor, right, we have access to a lot of private companies, which are often recruiting for board members or advisors or full-time staff. Sometimes limited partners are looking for opportunities to engage with portcos. We often find they're limited partners who have a lot of intellectual capital, reputational capital, knowledge capital, in addition to their financial capital. And becoming a board member and advisor is a way to tap those other types of capital, particularly for semi-retired people, and be engaged. And that's valuable. They enjoy it. It's good for them, and it's good for the companies. We also find as a fund manager that there's value in offering LPs outsource DD, right? Say to them, look, you're not an expert in this space. I am. Send me your companies. I'll do DD on it, and I'll share with you my results. You can also offer community, which we certainly do. You can offer tax minimization. We have done a lot of QSBS sensitive, compliant investments in the past. The U.S. government is saying to us we should, they want to encourage investments in private companies. I'm happy to oblige. Co-investment opportunities, that's a huge one nowadays, right? Many allocators are specifically looking for opportunities to do that. And then there's some people who just want to learn about VC. And so we offer an LP in residence program where folks can learn more about the industry by getting meaningfully engaged, coming to meetings and so on.
Wow.
So as promised, that's a 15,000 word essay in 40 minutes. I would welcome any questions you have.
Wow, David, I am impressed. You really packed a lot of information, and I'm grateful you're sharing the slides because there are so many companies you brought up that I want to learn more about. I mean, just some phenomenal examples. I know there are some questions in the chat already. Would you like me to go ahead and just read those off in the order they entered?
Sure. I actually do not see the questions.
All right.
Wait, no, I do see them. Great. I've got it pulled up. 1 second. Okay. So question from Mahir Avazov. He says, which investment, or actually, Danielle, why don't you read?
Awesome. Perfect. Mahir, thank you for submitting. It says, which investment activities could be considered attractive for next gen to join family offices as a career path?
So my 2 prior funds were anchored by different families. So this is dynamic. I've gotten very familiar with. The first thing to think about is generally you don't want to get a job just because you happen to come from a family of means, right? That's not a healthy dynamic. You want to get a job because you're a smart, ambitious, talented person. So there's a well-known German family, like super well-known, where their daughter specifically used a different last name because she didn't want the burden of having this well-known last name. And in fact, the story I heard was she got engaged to her husband and only then share with the guy her real last name. So you may not want to go to that extent, but I respect the logic of it. So Mahir, I can't, without knowing your personal resume, that would be my first filter, right? Like, where do you go to school? What did you study? And I would sort of assess you like any other young person. Then the question I would ask is, how do you leverage your family background, right? We definitely did that at FF Venture Capital and Hoff Capital, where we had families involved with reputations in certain industries and credibility. And we did that in a couple of ways. We leveraged it to meet other similar families, which is certainly helpful for fundraising, to meet other next gens who we knew would be, if not LPs, they would certainly be additive to our portfolio companies. I would emphasize that one logical path for someone from a family office background is get into IR and fundraising, but you're sort of, the market will read that as that's your main value add, is the fact that you're networked, right? And if you look at who runs investment management firms, it's not usually people who grew up through the IR path. It's usually people who grew up through the investment path. So I'd encourage you to think about getting a job function where your job is more pure investing and your family background is kind of irrelevant or less relevant. And then if later in life you rise up and are CEO of this firm or you start your own firm, then the family background will become very relevant. Want to go to the next question?
Yes. All right. So Sudipto actually has a 2-part question. I'll start with the first one. I'll read the full thing, but I can reread the second question. Could you share your perspective on the scope, progress, and success rate of solo entrepreneurs entering the categories you mentioned? And he goes on to ask, additionally, I'm curious about your track record with investments in job automation and enhancement opportunities. So can come back to the second, but success rate of solo entrepreneurs entering the categories you've mentioned.
So first off, I share the bias of many in our industry for teams as opposed to solo entrepreneurs. There are, of course, many examples of solo founders who build great companies, but it makes it a lot easier when you have a partner. So if you are a solo founder, the first thing you need is you need a team, right? So you need your first employees, and maybe they're employees as opposed to co-founders. But part of my due diligence on you is, who did you win as your first few employees, right? Because you're a high-risk startup. Your ability to sell joining you is a good proxy for your ability to sell to the clients of the product that you're eventually shipping. So Google Ventures published research on the success rate of serial founders. They found the following: if you were successful in your prior venture, you are more likely to be successful in your subsequent venture, subject to the condition that you're in the same city you were in previously. Why? Because so much of entrepreneurship is context relationship dependent, right? You're in New York, you have a lot of relationships in New York, and you're going to recycle those for your next venture. If you move to, Bali, you're not able to do that in the same way, and that will hurt you. To your question about track record, so specific track record, I'd rather talk about offline. I would say job automation is a super, super hot area because of AI, right? I have a case study on my website of how one VC firm that I've advised to Ferris used AI internally. I'll share the chat, but what I'll highlight there is, here's what they did. They did an in-house workshop where they required everyone in the firm to attend this workshop, meaning from the admin to the partners. They gave them basic training on how to set up a ChatGPT program avatar customized for certain processes. The admin in the firm, she runs certain processes. She's the expert in those processes. She can and should use AI to run it, but because I don't run those processes, I can't do it for her, right? It's much better if she is trained in how to do it. So I think that's the right mindset, right? You're not going to lose your job to an AI. You will lose your job to someone who knows how to use AI tools. So I want everyone in the firm, the company, to take advantage of these modern tools. And the opportunity for workflow startups, like the ones that Sudipto referenced, is to do a better job than the big vendors, the ChatGPTs of the world.
Great. Thank you, David. Let's see. Simon asks, what do you make of AI in investment tech? Is there a geographic focus to it?
So yeah, I'm maybe biased here, but obviously the investment industry is centric on New York and secondarily Boston, San Francisco, LA, right? And so there's a disproportionate number of such companies in those geos where the clients tend to be based.
Excellent. Looking ahead to 2025, is there something that you feel asset managers should be worried about in the year ahead?
A lot of things, right? There's lots of geopolitical volatility in many different hotspots around the world. I'm an Israeli citizen, so I feel like Israel is actually in a pretty good place with only one enemy that hasn't been meaningfully defanged, and the Houthis are relatively weak and relatively far away. So I'm feeling pretty good about that. But could North Korea blow up? Could, Russia declare victory in Ukraine and, right, basically wipe out Ukrainian culture? Absolutely, yes, that could happen. And could Russia invade other countries in Europe? 100% yes, right? Very likely to happen if they have success in Ukraine. That's why the Poles and others are well aware of it. So I am nervous about all that. The question for me, because sadly war is way, way, way outside of my span of control, is how do you mitigate these risks, right? So that's one of the reasons why I talked about pre-data, right? A tool for monitoring these emerging risks. For example, they claimed that they had some of the first indicators that COVID, or at the time, just this weird disease in China, was going to be a big deal. And you could have protected yourself physically and financially if you had figured that out early. I also think that we're in a world where multiple passports and having multiple categories of assets is a really good thing. People don't realize that one of the reasons why the US is so wealthy is we've basically had this uninterrupted streak of, generally speaking, stability, right? But if you look at most countries in the world, they went through periods where the stock market absolutely cratered. Argentina, Germany, right? And really destroyed an enormous amount of wealth. And America is not immune. Really bad things can happen here too, and I certainly have concerns about that.
Okay, great advice. Paul asks, are there any thoughts around how Bitcoin will fit into the overall family office investment ecosystem?
So I would say in the new Trump administration, there's going to be a lot of pro-crypto activity. The Trump family and David Sachs and other key people are big holders of crypto, so they're going to sell their book. That does not necessarily mean that it's a good thing to invest in it, because you still get in this issue that for many, crypto is a big, big term, right? For many types of coins, you still wrestle with this issue of what is the underlying use case for it. So I don't want to get into the religious war here of crypto versus crypto skeptical people, but I would say that I will share one of my favorite anecdotes about Warren Buffett. He was asked by a journalist, you write a lot, you share your strategy, right? Like you're an open book in how you make money. Why bother, and how come more people are not pursuing your strategy? And Buffett said, well, most people want to get rich quick. So I would say crypto is a great way to get rich quick, but there's certain volatility to it. And I think getting rich slow might serve some people better in the long run. Why don't we go to Salvador's question?
Perfect. Salvador asks, what investments in emerging deep technology will accelerate the transition to green and climate technologies?
So this is a little outside my expertise. I would say that Robert Heinlein famously said that when predicting the future, people tend to underestimate technology change and overestimate social change, right? The technology for green energy, right, like solar energy, has progressed amazingly quickly, right? But changing behavioral patterns so people don't think that a big car is necessary to satisfy their ego, we're a long way from doing that. So I think part of the trick here is changing the culture, changing the norms, so people don't feel like they have to have a huge house and a huge car, and are satisfied with smaller, maybe a little less physically, because that will reduce the carbon imprint. That will certainly help to mitigate the climate crisis.
A lot of psychology there. So those are all the open questions in the chat. This is your opportunity. If anyone has any additional questions, they would love to be answered live. Such a great opportunity to hear from David. If not, I have just a few closing comments, but sometimes when I start the closing comments, the questions all come pouring in. All right, well, feel free. I know David has shared his contact information, so you're free to continue the conversations with him. But yeah, I just wanted to thank you all for being here. I know time is our most valuable asset. And so, a special thanks to David for making himself available for this time. And a thank you to all of you for participating. And we do have another from Nigel. Do you think the fundability ratings of startups could improve the quality of deal flow for family offices?
So there are a bunch of companies with various permutations of fundability ratings. I've just put in a link for that.
Awesome.
So let me share it in the broader chat, actually. So this is a crowded area.
Mm-hmm.
I would say that one of the big challenges that all these firms have is if you're relying on public data for especially small private early stage companies is always going to be quite partial. So it can be helpful, right? There's definitely value in vendors like Synaptic, and CB Insights, which offer data about these companies. But to really understand the company, you actually have to get access to their data, right? Like look at their deck, look at their financials. That's not publicly available. And an outside vendor is not going to have access to that data. Now, there are firms which will, like Wokalo, which will, you give them the data, right? So you give them the financials, you give them the pitch deck, and they will write your investment memo for you. So I think that definitely is value. And some of them offer some sort of quantitative rating of it. I do think that VCs, like I think I have job security for at least a few more years before AI replaces me, where I think there's enough fuzziness and lack of historic data that there's a need for human judgment. Generative AI technologies are really, really good at situations where there's a lot of data and you're using established patterns. VC as an industry, the whole business is about identifying new patterns, new technologies, new economic dynamics, new social dynamics. And so therefore there's less historic data, because you actually have to understand what's going on as opposed to just doing stochastic parroting, which is basically what generative AI technologies do, where you're just repeating past text patterns.
Fascinating. All right. Of course, this is how it always happens. Far more questions in the chat. So we'll get to as many as we have time for. Dirk Hall asked, what tech services can private wealth advisors use to help its clients prepare for exit succession? And I believe you mentioned a company, but I'll let you answer.
So first off, I did a detailed breakdown of Living & Company, which is a multifamily office. I put the link in the chat. So I think that will give you some good ideas. Hey, Dirk, business school classmate. So I'd say that I'd have to speak with Dirk offline about more granularly what his concern is. If the question is tax minimization and so on, there are certainly some companies offering solutions for that. The issue of how do you identify, how do you think through the implications of family, like this very common dynamic of, the family sort of earning a couple $100K a year, and then suddenly they have a $50 million check, right?
Right.
So what do you do with that? How does it impact family norms? Do you tell the children? I remember talking with a guy who's probably an 800 mil net worth ballpark, and he told me his 30-something children, they know their dad is wealthy. They don't know how wealthy. He doesn't want them to know. Thinks it's bad for them to realize the numbers at that level. And he's basically waiting until he dies for them to figure it out. So I respect that.
Yeah.
Next.
All right, Varun, is cold calling the best way for emerging, aspiring fund managers to work with family offices, especially for someone who doesn't have a family background or either wealth or business?
Well, Danielle, I think you're a great person to ask this question of. I have an answer, but why don't I let you answer first?
Okay, so I am a firm believer. I absolutely hate cold calling. I feel it immediately puts someone on the defense. I understand there are people who are very well versed in it and they can make a connection and they can save themselves time. But I think in general, family offices are very relationship driven. And I think you want to prove value and build that over time versus kind of just catching them off guard. So that's my own personal preference. We give a lot of strategy in how to find connectivity, how to show value and alignment, and really be a magnet that attracts people to what you're building.
I agree with you. So I'll share another anecdote. So I've worked with a variety of placement agents over my career. The two most effective had completely contradictory strategies. So there's one guy who's basically a spammer. I didn't want to work with him, but one of my colleagues did, so he engaged him. And this guy had various lists, and he would ping a bunch of people saying, hey, do you want to invest in this fund? And he got some money, right? He got rejected a lot, but he just sort of took it as that's the price of doing it this way. And the other person was someone who came from a wealthy background. He went to the right golf clubs, and he would ping 10 people and got money from some of them. So I think the latter strategy is far more time efficient, reputationally far better. And so the question is, how do you make yourself attractive to such investors? How do you plug in those circles? This is a much longer conversation, which merits a whole nother webinar. But very briefly, I would say you have to figure out what you bring to the party, right? So is it a party, literally, meaning you organize parties where people get to meet interesting folks? Are you a domain expert and you're a climate tech expert and you meet with people and position yourself as, I know a lot about climate tech, I'm launching the climate tech fund, and then the people care about it, they will want to meet with you because you're an expert in that, right? It can't just be the worst possible sales pitch is, I will make money for you, because every other fund manager on the planet makes the same pitch. It's completely undifferentiated. You have to have some sales pitch, which is something else, like I can prove I'll make money for you because I have this amazing track record. I am an expert in climate tech, and whether or not I make money, we're going to be good for the planet, right? Because you're going to be investing in companies that help to mitigate climate risk. Something else, because it's very, very hard to get people's attention. There are people who do it, right? Those are usually the people who have a decade of history and a big brand, right? Because you're then competing with Vanguard and Fidelity and all the big players, which is very, very difficult.
Thank you, David. Great advice. And last one, we're sneaking it in. Goldie asks, products allowing keyboard liberation in healthcare have been hot topics. What are your thoughts on that?
So keyboard liberation, I confess, I just Googled that. So
we an expert in all domain.
Yeah, so okay, so now I know what the person's talking about. I think I know, but I wanted to check. Yeah, so look, I certainly recognize the pain point. I have a lot of doctor friends who complain about how much their time is spent keyboarding, right? And not even value-added keyboarding, just like entering in data about what they did with a given patient. Um, so the New Yorker, by the way, had a great piece a couple of years ago on the implementation of technology in healthcare, which a priori you might think totally makes sense. We should track what are the patients doing? What drugs are they getting? Right? Like that seems so obvious. But when you actually look at what happens in hospitals, what often happens is the doctors and the nurses and so on spend a huge percentage of their time entering in data in the format that the system needs, and basically performing to the machine instead of performing to what the patient needs.
Mm.
And that reduces their morale. It also can create some perverse outcomes where people are more worried about looking good to the the private equity investor in the hospital as opposed to doing what's best for the patient. Um, a great example that I remember reading when my wife was pregnant, that the rate of C-sections in certain hospitals goes up 3x on Fridays, Friday afternoons. Why? Because certain doctors want to get out of there to go away for the weekend. Not in the woman's interest, but got to hit that tea time. Um,
Wow.
so, I certainly hope that AI will get good enough and reliable enough that we can free doctors from the keyboard and then focus on serving the patient.
Agreed. Well, I know we have gone over by a minute, and David, I cannot thank you enough. This has just been such an informative session. Thank you for everyone who stayed with us to the end. We still have a great audience here. Today's session is recorded, so I will send out a follow-up tomorrow. I'll be sure to include the information David shared on the last slide, how you can continue conversations and follow his work and remain in touch. I'll also include details for next month's masterclass. I hope you all continue to join us, and I hope everyone enjoys the rest of their day, the rest of the week.
Thank you, Danielle. Take care.
Thank you so much. Have a great day. Thank you all.